I think this is almost like the calm before the storm. 2023 was the worst year for global M&A in the last 30 years. It's now been upgraded to 2026 is a great year to be planning your exit, to be dreaming of an exit.
Today we've got on Paul Hanley. Delighted to have you on from the Fortia Group to discuss all things M&A, big exits, big multiples. A lot of the brand owners and operators we speak to have a magic number that they're aiming towards in 3-5 years. We saw a couple of those big deals that almost provide like a leading indicator of maybe what's to come for the next couple of years in Wild, in Road Beauty, to Elf. It was noticeable in 2025, such a huge boom, crazy valuations, a lot of poorly allocated capital.
So if you're in that position where you are starting to gear yourself up for an exit, what does that look like through the eyes of a founder?
Give an ecom business enough time to mess up, it often will. I always say this to founders, the number one growth driver of enterprise value outside of growing revenue and EBITDA is...
Welcome back to another episode of DTC Diaries. I don't know which camera I'm going to be looking at here. Just turns to the side, there's a lot going on. Today we've got on Paul Hanley. Delighted to have you on from the Fortia Group.
Thank you.
To discuss all things M&A, big exits, big multiples.
That's right.
Yeah, thank you for coming on, Paul. I think a lot of what we focus on this podcast is like executional. It's the here and now. It's the tactics that are helping those watching grow their brand faster, hit targets next month, hit targets this year. But obviously there's an end goal for pretty much everyone who's running an ecom business. Some people may never want to sell, that's fair, but a lot of the brand owners and operators we speak to have a magic number that they're aiming towards in 3-5 years. And really excited on this podcast to dig into a bit about your story, a bit about how Fortia help brand owners go on that journey. Yeah. And also a bit about what maybe many of them miss that doesn't allow them to reach the heights or reach the value and realize the value on the assets that they've put so much time into. So yeah, delighted to have you on.
Yeah, great. Thanks for having me. A big fan of DTC Diaries. I follow your guys' podcast, the episodes, avid watcher. Great to hopefully bring a different lens to the discussion, which is talking about the end game and, you know, the ultimate exit. We've all seen the big headlines. As you say, I think it's making more founders think and dream and hope and aspire to have that big exit now in the next 12 to 18 months, whereas the last 2-3 years have been a little bit doom and gloom. Founders have been, you know, head in the sand, busy getting through tariffs and COVID and operational hurdles like that. But you know, we keep bottoming out. We keep saying the worst is here. The worst is here. We get a new worst. But the great thing is for 2026 and for the next 18 months, I think we're seeing mega deals as the catalyst and the accelerator for high volume in e-commerce to come. So thanks for having me. Great to be here.
Yeah, I want to go on to your story, but I think you've just kind of encapsulated what the landscape for what maybe the last 5-6 years from 2022 post-COVID, uncertainty that we've like to a level that maybe we've never seen it before, and such a huge boom, crazy valuations, a lot of poorly allocated capital. And then the sort of not the bust, but the huge dive that we've seen off the back of that in confidence and multiple and natural activity in the M&A space. Yeah, it was noticeable in 2025 from, I think we've discussed it on the pod a couple of times, that we saw a couple of those big deals that almost provide like a leading indicator of maybe what's to come for the next couple of years in Wild, in Road Beauty, to Elf, which is exciting, right? And like you say, hopefully that's a sign of the times. Do you think that's where we're moving towards? Do you think we're seeing that?
Yeah, I think the two examples you referenced are slightly different, and they speak to things that founders are navigating and asking themselves questions internally now. It's number one with Roads. Obviously, influencers are having a huge impact on the space, and it's not just about influencers that we had maybe 3 or 4 years ago, where you had, you know, affiliates. It was more affiliates. Now you have influencers, you know, rolling up their sleeves. You had IM8 here, who you've got Danny Young and David Beckham, and you know, David Beckham is not just a face that's referenced. You know, it's a real problem that he's passionate about. The brand can stand on its own 2 feet. Roads Beauty is associated with, you know, its founder was Hailey Bieber. You know, she's still involved post Elf acquisition. So they're getting more involved, and it's brands partnering more directly with founders. It's not about one-off posts anymore. It's about real accreditation and real partnership with these highly leveraged people in terms of a community. The other thing then is which is interesting with Wild, is brands really tapping into what's happening on the macro. So, obviously sustainability trends, a big retail story is combining your own vision with what they want and see aisle spaces to be like in the next 2-3 years, getting away from aerosol cans and kind of bad use cases like that to more sustainable products. That's something that strategics and the right strategic will pay for today and model out. So 2 very different case studies, great case studies. We all hope that Rhodes Beauty doesn't become like the Dollar Shave Club kind of example in years to come. I think there's different strategic rationale there, but it's definitely paving the way for maybe high volume that's going to happen in the mid-market and lower mid-market to come. Everything drip feeds. Like to go back and set the scene, I guess, as you talked about, 2020 was like the great gold rush for ecom. You had the huge COVID boost. Everybody said the high street was gone. We're never going to talk to each other again. No one's going to go outside. Ecom's here to stay. I think good case study for that in the UK was Primark. Went from, millions and millions of revenue to zero overnight.
Yeah.
So ecom was the new big thing. Obviously you had the rise of the aggregator community, the 16 billion of capital raised at that time. I really feel quite sorry for them because they were forced to buy pumped up assets, brand assets that had this, kind of almost false boost from COVID spike demand. And because there was such a crazy frenzy for these brands, everybody bought an insane valuation. We can touch on that later because I think folks like L'Oreal and Elf and stuff, they're paying what we see as insane valuations now for maybe stuff. And they're really active, like especially L'Oreal, super active in the space. But I think this is almost like the calm before the storm. Everything's cyclical. We follow on from the great gold rush was the Great Depression in 2022. We saw the second half, interest rates went through the roof. Folks ran into debt issues. They couldn't service the debt. Increased interest rates impacts modeling, valuations that both strategics and private equity can pay for things. Everybody got super nervous. 2023 was the worst year for global M&A in the last 30 years. The ecom industry was impacted by that, and consumer M&A was impacted by that. And then, there was the great hope in Trump at the time, who was good for the markets, good for business, a businessman coming back into the White House. And, the markets started to react well just at the second half of 24. But then, he dropped the bombshell of reciprocal tariffs. Yeah. And we're now seeing a bit of a shift in, not to get too deep on the macro, but we're now seeing a bit of a shift in global power and partnerships where you've got China, you've got US, you've got Canada, Russia. They're all figuring out where they sit in terms of partnerships. And the US is very much saying, we're the global superpower, and tariffs are making everybody in the ecom world rethink supply chains, causing investor nervousness. But mega deals, like in all sectors in global M&A, mega deals seem to, be superfluous to some of these things. Strategics are willing to roll up their sleeves, and acquisitions can't sit on the sideline forever. There's so much private equity capital that's been sat on the sidelines for the last 3 or 4 years that, is desperately waiting to be deployed. Strategics are kind of the front runner. They're doing big acquisitions. I think that's the catalyst to what's to come. So to summarize all of that, the overall grade, I would say, for your DTC founders was 2023, I said, was a fantastic year to be building an ecom business, not selling an ecom business. Outside of those mega deals, it really, anybody that sold a business in the last 2 to 3 years probably did so out of necessity rather than chasing crazy valuations. Or they found, a strategic partner that made sense. It's now been upgraded to 2026 is a great year to be planning your exit, to be dreaming of an exit and what does that look like and connecting the dots. So, if you're interested in exiting over the next 12 to 18 months and you've in 2023, you were busy building an ecom business, I think you're in a really great position.
So if you're, I guess, in that position where you are starting to gear yourself up for an exit, what does that look like through the eyes of a founder?
Yeah, it's a good question. So I would say, founders have so much on their plate. They have to solve the world's problems. They have to get consumers to buy their products. They have to, show all the right data, have their financials in order. I think I would say this as an M&A advisor, but the best thing that they can do is in 2026, when there's so much happening in the ecom space, is do what they're good at, which is all that stuff, and leave the experts to be experts. You guys have an agency that get involved with brands to help them scale. That makes sense. You guys are experts in that. So let an M&A firm show you where the market is at, where valuations are at, where both private and public market comparables are, and kind of set the landscape for you. I think what the M&A advisor really wants the founder to bring is a robust and data-driven forecast for the next 2-3 years. And I'm not talking headline figures, we're at 10 million, we want to grow to 30 million. Everybody wants to do that. Show me SKU by SKU, channel by channel, with your customer cohort, how that's going to be possible. One of the friends of the Fortia Group that we do a lot of work with is Theta. Theta, for any DTC founder out there, their co-founders, Peter Fader and Daniel McCarthy, are experts in LTV, customer LTV, lifetime value. They obsess over it. They actually lecture on it. LTV to CAC, the golden metric for DTC businesses. So understand that. Daniel McCarthy at one of our annual summits said something that has stuck with me ever since. Ecom founders and ecom-led businesses are different to your traditional brick and mortar. Traditional brick and mortar businesses like Water Wipes, who we might touch on, very ecom focused as well, but had a lot of activity in brick and mortar. You've got to buy expensive data. The customer isn't yours, and you get limited insight into that data. Like if you're buying data from Tesco and Humvee, you get limited insight into what's happening, and you got to make serious decisions based off that. Ecom businesses, the thing they need to realize is they're data companies. They're harvesting data all the time, and your data needs to tell a story. And when it comes to valuation, your data will either back that up in terms of a forecast, or it won't, and it will have gaps. So what should founders be doing today? Number one, they should be building a really data-driven, robust forecast, which is the Bible and the guide for the next 12 to 18 months. And then, if they're interested in exiting, marry that up with what's happening in the market and see if there's any blind spots. See if you can solve it today.
I think the forecasting piece should be a hygiene part of any DTC brand ongoing. It's like we build and work to forecast for every brand. It's like it's our best guess or our guesstimate at what the next 12 months is going to look like, and then we hold ourselves accountable to that. And I think it works really well because it's a yardstick. And obviously, ideally, you just blow past it and you end up doing 3 times as much new customer revenue in a month as you planned. But I think
because you've outlined, like your forecast should not be a dream. It should not be an aspiration. It should be data-driven for, based on me executing X, Y, and Z, here's what is realistically in front of us. If we miss this, it's not good. If we overachieve it, that's great. We've probably undercalled stuff, or we've executed other stuff that we've since baked it in. And forecasting becomes really important when you start speaking with acquirers, because you really you don't want your valuation, if portions of it are going to be baked into earnout, to be based on aspirational stuff that's not realistic. That's going to set you up for failure. You want to get them bought into a data-driven story. And you also want to, Emmett, our co-founder, who's ex-Morgan Stanley, says something to me that always sticks. It's like if Warren Buffett was in, the elevator with you and you had 20 seconds to pitch your business, can you do it? We speak to most founders on a kickoff call, It genuinely takes 30 minutes for them to intro the business.
Yeah.
You know, your data should tell that story quite clearly, and you should be able to articulate what your company is, how your company is performing, and what the goal is, you know, within 2 to 3 minutes.
What does that look like? Because I think that's a really interesting point, like how you communicate your vision, the narrative, the story is what will drive buy-in alongside, as you say, it's the tying the data then into that story.
Yeah.
Which kind of is you know, the hard skill with the soft skill in many ways. And once you've got that forecast, how do you articulate that into a narrative? What I guess separates the good founders from the bad in that sense, that you've maybe had those conversations with, in the way that they are able to articulate that story?
Yeah, it's a good question. So I think most of it comes down to you've got growth tactics. Any founder sitting watching this today will have 10, 12 growth tactics that they can execute on. If you're a DTC company, you want to be an omni-channel company. You want to get into brick and mortar. You know, it's baked into your forecast. Well, have you had those conversations with buyers? Do you know realistically what the CPI kind of structure you're going to have to get into? You know, the cost price agreement, the structures you're going to have to get into. Do you know what the margin profile of that channel looks like? Do you know what the growth from that channel realistically looks like? And I think, you know, where there's too much hopes and dreams and I will and I could and I might in there, that takes a long time. And founders have to be dreamers. They have to be visionaries. They have to be passionate. But remember, at some point, if you're going to exit your business, you are going to be faced with a quantitative, financial focused guy who's going to take a real hardline look at the business. If you sell to Elf Beauty, you're not going to be sitting down with the CEO who probably has hopes and aspirations for Elf. It's not going to be visionary on visionary. It's going to be visionary on hardline financial M&A folk. So I think, you know, for founders, again, speaking with an M&A firm and getting their unemotional, impartial view as to where the story is today. And sometimes that's a good conversation. Sometimes that's a bad one. Sometimes I speak to founders and they say, I want to exit for this valuation. Everybody's got a cash valuation in mind. And you might look at it and say, God, you're sitting on a gold mine for X, Y, and Z reasons. Or this strategic is really active and your asset completely fits their synergies and their portfolio. They may pay a really high multiple based on this transaction. So the cash value, the timeline shrank. More often than not, it's extended out because it's like, okay, you want to grow to, you know, 30, 50 million in the next 2 years. And everybody, you know, you'll never see investment pitch deck that doesn't have the hockey stick. You'll never see,
especially early stage.
You know, it's quite often
getting to 100 million in 5 years.
It's quite often in the M&A sim. It's the hockey stick approach again.
Yeah.
But it's like, but how are you getting there and being able to articulate that? You can say with a cold stone face if the data matches up and it's correct. You know, if MPD is a big part of your strategy and you've been successful at it to date, you can say we're launching this, and this, and we're going to have success because of A, B, and C. That's quick to do. When it's too aspirational, it drags out.
So I guess that's like 2 key things, right? Well, maybe 3. You've got like the simplicity, like able to articulate a business is what a business is and where it's going very simply.
Yeah.
You've got clear data to back that up, and then I guess a clear narrative and clarity on how you're actually going to bridge the gap between the here and the now and where you're going.
Yeah. Like you know, sorry, but what are you bringing to the table? Because the book doesn't stop with just revenue and EBITDA, especially if you're targeting a strategic. You know, who's your customer demographic? How is it different? How does it fit into their strategy? You know, with Rhodes, it was a premium brand. It was a higher AOV. It was getting into prestige beauty, which, you know, Elf really wanted to do.
Filling gaps, right?
Exactly.
Things that they'd find really expensive or maybe just struggle to do internally.
100%.
They can bolt on.
Everybody knows about the growth. Like, not to disrespect what they've done, because it's fantastic. I wish I was the founder of the business. Yeah. But you know, with Hailey Bieber's network and her authority over that network, followers were always going to follow suit. but it's what did they bring to Elf Beauty? It wasn't just revenue and EBITDA. It was, customers and a different positioning.
Culture.
Yeah.
What do you think that is for Wild? Because I've just seen Unilever's launched a massive sustainable deodorant line with Dove. It's like those two things are, I think for Hailey Beaver and Rhode and Elf, it's quite clear and quite tangible.
Yeah, like Elf has an extensive retail network that they can put a predominantly DTC led brand
Just
through and
distribution and just like
and
just lowers the time to value on that acquisition.
Sure. That's great for modeling.
Yeah.
With Wild, I think I don't want to sit in the chair of Unilever and kind of prospect, but all your assets have to, Dove heavily influenced by, what's happening in brick and mortar retail. Yeah. So, they've got to also align with where the retailer wants things to go. And it's a portfolio play. You can't just put all your eggs in one basket and say our sustainability cause is going to be driven by Wild. Everybody has to play ball.
I remember watching a video of the CEO about like their big bets for 2026 in marketing, and one of theirs was influencer, like the expansion of influencer. And I know Wild had a really good influencer rhythm within the business, and just Vault primary channel was this best in class influencer program. So I imagine that even tactically could be interesting.
And beauty. You talk at what M&A, what categories for DTC are hot. Obviously, beauty is one. Health and wellness is another. They're both booming. I think it's because influencers play heavily on that, but it's the customers so attuned via social media and so receptive to new things, and they want the new thing. Whereas secondary categories, I would say, are baby and pet. Baby and pet, recession proof. Everybody needs to buy things for their baby. People are more likely to give their dogs medicine than take their own. These things are recession proof, but they're more when you go and you make those purchasing decisions. Moms will kill you if you launch a bad baby product. Moms will come to your house with pitchforks. They do their research. It's not just about the new thing. There's credentials there and credibility. So I think influencers play a really important part of health and wellness brands and beauty brands, like male grooming exploding right now as well. It's very key as well for those other categories like baby and pet, but maybe a differentiated strategy. Like for influencers now, I would be saying for DTC founders, what can they do that's differentiated? Like IM8 obviously did a great job of partnering with David Beckham, and it's not just about his name; it's about the fact that this is something that is a passionate venture for him. It was a real problem that wants to take all these supplements, right, to do the right thing, but doesn't want to have 18 jars sitting in his cupboard and take 18 different pills. There has to be a better way. So for influencer strategies, I think it's really key, that you find someone who's going to truly partner with you, not just do the one post, set it and forget it.
Incentive aligned, right?
They do constant publishing, or they help unlock doors with other, backers. And then there's a tier 2 below that, which is more kind of affiliate,
experts,
people with great networks, experts in their field, getting share of voice and awareness out there.
IM8's really interesting, and we work with a business called Axe as well, which we talk a lot about.
Yeah.
I just think I've been reading a lot of this concept about last mover advantage loads. I think they're such, maybe not last movers, but such great examples of how you can enter a category that feels like it's been done, hammered to the, like just drummed into people, and come with a better, newer, shinier proposition in those two areas that you mentioned, where consumers are always looking for the new, the better, moving forward, and create a hugely valuable asset and a hugely valuable brand very quickly.
You don't have to invest in the education around
that's it. So
someone's already paved the way and done the more expensive hard work of creating that category or that that demand for you, and you're just kind of like, I think that's just, it's always tempting to feel like you have to innovate and create something completely new if you're at the start of that brand journey, but there's really good examples of building behemoths without having to do that.
Yeah. So one of the without going into pitch mode, one of the things that separates, I guess, the Fortia Group from maybe more traditional M&A firms is, we obsess over e-commerce. For the last 5 years, we've been exclusively focused on e-commerce. E-commerce valuations and deals is all we think about every day. So to do that, Emmett's ex Morgan Stanley, Credit Suisse. We have our investment banker in-house, second co-founder, David Hyland, who is our in-house financial expert, ex-SaaS and ecom SaaS tech CFO. And then there's myself, who have been involved with ecom operations for the last 15 years. So that becomes important when you talk about positioning and articulating performance, both today, where the valuation is today, but also where it can be, looking at forecasts in due time. To accelerate on that, one of the things that I've done is I've co-founded a brand incubator that's based out of Texas. And one of the assets that we have under management exactly does that and talks about last mover. Like we're particularly targeting a niche where one behemoth has spent hundreds of millions on building awareness, and they've really struggled for profitability over the last five to 6 years. They're profitable now, but they're valued at almost $1 billion. Not going to talk about the niche, but our strategy
Trying to guess it whilst we sat here. I can't.
Our strategy is to come in and leverage off that awareness and build a more profitable kind of model that, if we can target 10% market share, we'll grow to an insane amount, and we don't have to have the top tier influencers or things like that on our books that they would have had to drive awareness and build a niche. So I think that's really interesting for, DTC founders. Where do you start? I think you can start from multiple locations. It can start from your own passion, which is a great place to start. You'll always find ways to make money if you're truly passionate about something.
Yeah.
The other place to start is if you're a kind of a finance geek, almost like myself, you'll look for gaps in the market and where you can fill. But then if you get really smart with that, you'll identify spots where, there's huge awareness driving in certain niches, but that secondary brand that just wants to sit behind and gain market share off the back of that, you can build a really successful business off that. That's profitable.
Yeah, I was pulling some notes together, and I wanted to ask, what do you think is hot now, and what do you think is going to be hot if you were crystal ball next 3 to 5 years?
Yeah.
Prior to that, you mentioned that approach to finding opportunities. We obviously get to see 200 plus, 300 plus brands that come through our lead funnel every month, and it's always, it never ceases to amaze me when you'll come across a brand that's operating in some really boring niche category, but doing crazy numbers. An example was a chicken feed brand that came through, and they were doing multi-million a month supplements for chickens, just a brilliant business, just so left field, but piggybacking off this whole pet wellness hype, but just in a different way to how everybody else is approaching that market.
Yeah, I think I probably know the brand you're referencing, but because we've come across them as well. But they've effectively, in maybe a B2B landscape, they've just developed a B2C kind of solution, and almost found out that chickens, I think, is the number 3 pet globally. And the great things about chickens are not to make the whole podcast about chickens, but it's not like dogs. You don't get one and then in 2 weeks' time you've got 4. Whereas chickens, it can be like that. So the demand almost creates itself. But yeah, there's lots of niches out there that either maybe B2B focused, but you can build a really great B2C brand around that. And I think they're doing great stuff.
Yeah, 100%.
Yeah, I was going to say another way to view that as well, and I would like to get your thoughts on whether this is something you're seeing more and more, is almost the idea of tying proprietary tech or SaaS into D2C brands. I think you're seeing it through, I think we had Pure Pet on the podcast. they've even from a logistics point of view and how they have built their own almost data infrastructure internally within the business that is very bespoke to them, how that in itself will, how that will potentially impact their valuation as a business as in terms of intellectual property. Similarly with, I think, Tails.com sold for crazy multiples, almost treated as a SaaS product. You've got the likes of Ring Doorbell, Huel, who have built like internal logistics systems, apps now where it almost the barrier to entry to tie tech into your business is so low because of AI and no code. So is that something you're seeing more, and how are you seeing that like used as a strategic lever to drive valuations?
Yeah, I don't see it as being a huge driver of valuation, because for many sub 100 million like DTC brands, the reward of buy versus build for like AI and these kind of things is work with agencies who are adopting these. I think it's a real challenge for acquirers, but I think the thing it does is it's like a hygiene check across the P&L. If there are ways in the P&L that you can reduce your OpEx costs, you can reduce your overheads, you can be more efficient with MPD launch, you can be more and harvest more data as a data company, which ecom companies are, then great, do it. But am I really seeing DTC brands say we're the next AI thing that we're making decisions based on AI and it's great, and everyone's now kind of viewing it as, is it an ecom business? Is it a tech business? I think ecom founders have a lot more problems that they need to solve, like ring fencing their consumers and getting them away from competition. And one of the great things you talked about was IP. Building up a really robust IP strategy to build a moat. We always talk about you want to build a brand with a capital B. I would say that starts with gross margin. And if you can make efficiencies with gross margin, then great. I said once that on a podcast or a webinar, I think with lots of people on it, that gross margin for ecom businesses now needed to be definitely north of 70. And I could see in the chat people were outraged by this. Gross margin for me is revenue less landed COG, but I love that as a metric because it encapsulates so much. It encapsulates pricing. Like I'm talking about as a brand, your gross margin as a brand. So pricing per product range, per SKU, AOV, is it increasing, decreasing? What are you doing on promotions? How are you getting creative there? How good are you with supply? What does the complexity of supply chain look like, and how's that impacting landed COG? I think showing hygiene improvements through adopting AI and tech in that, or who you work with in that, is really interesting and something that acquirers love to see. But I think it has more of a net impact on your base EBITDA than looking at an ecom business saying, okay, well, back of an envelope valuation for a DTC business is somewhere from like 5x to 12x. EBIT. Yeah. Now I'm going to say, because you've got this piece of tech, that you're a tech company, I'm going to value you at 25x, or 2x revenue or something like that. It's we're not seeing that, but it's a hygiene check throughout the P&L, which is great. Because ecom businesses, that's why I say gross margin needs to be above 70. I mean, for beauty businesses, heck, it needs to be above, needs to be close to 80, 85%. That's what we're seeing in P&Ls across my desk every single day, because CAC has increased, because logistical costs are fluctuating so much. I used to say, back in 2020 and 2021, 20% EBITDA margin was the yardstick of good. Back in 2023, it was 15 is the new 20, because logistical costs had gone crazy and CAC is going crazy. And unless AI is going to do a great thing, and it may do, I don't see CAC reducing anytime soon. You can make efficiencies in it and great, but there's going to be more and more competition, which is going to just, the only people winning out of the whole ecom bubble right now is like the Metas and Google and all these. But being able to show and demonstrating that you run a really clean book of business is always something you should be doing. You should be doing that whether you're going to exit in the next 12 to 18 months or not. So if you're not doing that today and you're worried about that and there's margin improvements to be making, then great, make them, because that's going to fuel your MPD. It's going to fuel launching a new channel that accelerates growth.
Saw an interesting tweet a while back about that Meta piece. It was like, how many founders would be better off if they just dumped the balance sheet into Meta stock rather than continuing to like scale the business over time, just based on how many DTC brands are basically just a Meta advertising business. You mentioned gross margin there. I agree. I think tried to do this analysis of like what separates our top 10% of clients from the rest, and it mostly is when you look at fundamentals like gross margin efficiency through like vertical integration, controlling more of the supply chain, and that creates an environment where you can just pay more for customers, especially at scale when you're hitting like CPM increases and more competition.
And I think when you're bringing your P&L to an acquirer, that's the aspect that they scrutinize over, because that's the aspect that's harder to fix. There's more risk in changing suppliers than making efficiencies in marketing. There's more, quality control risks, just pain in the ass of moving from China to Indonesia or wherever it needs to be for tariffs. So, if you already thought about that and done the hard yards there, and what's going to be hot in the next 3 to 5 years, I still think back to the macro where the world is struggling for who's number one, and, China and US, who's going to, where does supply chain live for ecom businesses? There's, I don't really follow Donald Trump with America first and everything needs to be made in America, because that's not efficient. Most ecom businesses have probably in the last 6 months priced up, hey, what would it take if I made my product in the US, and quickly gone, okay, that's not an option. But, I see the US market then becoming increasingly important. I know it's heavily fragmented versus a sole US market, like, that gets really interesting because you can single serve it with DTC or with Amazon. With EU, it's more fragmented because you got compliance, you got VAT, you got
language,
language, all the really
different
exciting
habits.
Stuff that ecom founders love doing on a daily basis. But I think what's going to be hot is showing that you've got a risk diverse supply chain, that you've got not just a reliance on one sole market. And often, when we work with clients and they want to speak to acquirers early, which is, by the way, one of the most important things we do with our clients, is we position them in front of acquirers and we get their feedback early, is what do I tackle myself as a founder versus what do I leave on the table for an acquirer to do? So often for DTC businesses, it's like, well, I could go omni-channel in the morning, but guess what? Boots is super aggressive on cost price, or I don't really know the US retail landscape well enough, or I've got to take a trip over and learn and educate myself. Versus an acquirer would say, but I already have existing relationships in these things and I've got more purchasing power. So when they speak to acquirers and they try and marry up the synergies, it's about what do they really want a brand to bring versus, what do they want to tackle themselves? Because if you go and tackle brick and mortar, it should bring more revenue. But sometimes what founders need to be careful of is doing these growth tactics might grow revenue, might grow EBITDA. It has no impact on enterprise value. So you've just spent the last 6 months painstakingly negotiating and launching, and your net impact to EV is zero.
It's also doing them wrong, right? If you do it and you fail, you can't tell the story.
Now an acquirer has to go in. First thing they do post-acquisition is go into Boots and negotiate and try solve that problem. That's not fun.
Just a faff, yeah. Makes sense. Same with new markets, I think. So I've spoken to a couple of people I know who operate inside like these holding companies or roll-up companies. That's a really attractive part of UK e-com businesses, is the idea of just taking them global if they've been very one market reliant.
Yeah.
It can be tempting to do that as a founder, but it's harder than it sounds. And if you've gone and done the US, failed, and then having that acquisition conversation and they're like, you can't tell the big magical story about go and conquer the US
that's
market.
exactly it. Yeah, it's like you know, in the back of any sim, you'll find growth opportunities, and you know, is the growth opportunity? Well, if you had done it right, it would have been X because I messed it up. So you know, you don't want to do something that almost disproves it. You want to, you know, if the US market is on your horizon, it's great to have a conversation with acquirers and see, would you like me to tackle it? Does that make sense? Or is it best to leave it alone? Because you don't want to just disprove that that's a valid market by doing it wrong. If that's the metric that you have to bring, that's where the elevator pitch gets longer and longer and longer.
I want to come back to categories, but I just wanted to ask a question because we're talking about like valuation here. Like what do you see as like top valuation drivers? Like you've mentioned gross margin and bringing something that they don't have. So like a premium customer to a more value-based business or strategic acquirer. Would you say there's anything else? And then on the flip side, what do you see as like maybe 3 or 4 like key drags that are really pulling people away from the value they want to realize?
So not to get too operational about it, because I do want to bring a different lens.
Yeah.
Then I always say this to founders, the number one growth driver of enterprise value outside of growing revenue and EBITDA is matching with the right acquirer.
Yeah,
and
that's Warren Buffett's whole thing, isn't it?
And
like
that's, that's not me to make a statement or a headline, but realizing then that takes so much time. Like, look at any of these strategic acquisitions that are making headlines right now. You know, Hailey Bieber didn't turn around one day and go, hey, I want to take a back seat on this. I'm going to sell my business. And Elf was just sitting there going, gimme. You know, the conversations were happening in the background. It takes a long time to understand on both sides where synergies lie. And how you parcel up your data and how you demonstrate and show that and disclose data to an acquirer is a really tailored approach, you know. And what a strategic versus what a private equity firm will be really interested in differs slightly. How they model up valuation is slightly different. So you need to really understand that and understand who your top targets are. So, you know, operationally, have clean data, have a really robust IP strategy if you can. Like, you know, if your moat as a brand is your network, that can be really powerful. You know, if it's a utility patent, that can be great. If it's unique formulas and you've got, you know, IP around that, brilliant. Having really clean data that tells a good story, having a really data-driven, robust forecast, all these things take time. Draggers to valuation are, well, not connecting with the market sooner, not understanding what the desires and needs are, doing things wrong, you know, not leaving enough on the table for an acquirer to go and tackle as exciting growth opportunities. Launching loads of MPD and hoping something will stick, that can be a concern. One big thing that people need to watch out for, I think ad backs, you know, ad backs is a bone of contention over the last couple of years. In 2022, the world was crazy. Everything was added back in. I think we live in a more sane world now where we see ad backs as a minimal. Really, if they're one-off costs that don't either influence the top line of a business or they're not really with continuity of business, they can be discounted out. But that's minimal unless you're running a lifestyle kind of P&L. That's minimal. Where we do see founders get shocked is where they say, I'm doing a really great job. I'm only spending 5% TACOS and I'm growing by 100% year over year. And it's like, well, you're running a sub 20 million business. So, you know, high growth trajectory is expected. But what does that TACOS peg need to look like for me as an acquirer? Because I can't live with a 5% peg. That's not really interesting to me. I don't want to scrimp and save on my marketing efforts.
Total cost of sales for those people who...
Total cost of sales, yeah.
For those non-acronyms.
So,
because there will be a few.
Yeah, acronyms. We all need more acronyms.
Finance and marketing, the two biggest.
But they will come to the table thinking I've done a really great job, and they almost see that discounted.
It's like unrealistic.
Because
right?
it's I don't want to live with that. I can't live with that. I need a peg. As well, OPEX, another bone of contention. I haven't paid myself a salary. I've been running the business out of my garage. It's been growing at a phenomenal rate. I haven't hired anyone. I don't have any systems. This stuff's just growing like a weed. My EBITDA margin is 20%. And because you've been fixated on that 20%, your gross margin's like 70, 68. But you say, but I've got 20% EBITDA margin, so I'm doing a great job. And again, acquirer comes along
They need to
and
put
says,
a team in. They need to.
I need a whole team to run my vision. So I'm going to discount the EBITDA by like 5-7%. And suddenly that has a huge knock-on impact on valuation. So just, I don't want to tell DTC founders how to run their business efficiently, because we all know how to do it or can speak to acquirers in doing it. But matching up those synergies and building relationships with acquirers and building a competitive auction process ahead of the auction process builds competitive tension. It's like a lot of your audience will have done crowdfunding. You know, you don't just list your crowdfund and list it and they will come. You got to put the hard yards in ahead. Anyone who's raised millions and millions via crowdfund has done painstaking work over the last 18 months to make that happen. It's the same with an exit.
Yeah. One final, just because I watched I think it was maybe might have been your last event, maybe it was in New York or somewhere in the US, and you did a talk, I don't know if it was yourself or someone else on your team, I can't remember, but around the concept of like customer concentration as well, and like how that's often not something brands look at enough, like how much of their revenue is and more so profit is driven by a very small percentage of total customer base, and how that can become a big problem when looking at the valuation of a company.
Yeah, so you know, if you're a large company and you've got heavily reliance on either, you know, let's take products for an example. You've got 50 SKUs, but you know 80% of the revenue is going through 5 SKUs. An acquirer is well within his rights to say, I don't want the remaining SKUs because they're not doing anything. Yeah. And you know, so your revenue is discounted, but then you've got stock holdings of those SKUs and they're discounted as well. And suddenly it's becoming messy. You know, M&A is all risk. It's all risk. So it's about how do you diversify that risk for an acquirer? How do you make it less risky? Because they can write bigger checks if it's less risky. So you reduce your reliance on channels, on how you acquire customers, on your customers, products, things like that, geos. You know, how can you prove that it's not just reliant on one thing? And you know, that's a great way to build investor or buyer confidence.
So we've got you know, quite a few seasoned founders, should we say, that listen to the podcast. We also have some that are much earlier in their journey. I'd love to, like, let's say maybe pre-revenue as an example, that maybe are looking for that product. They're looking for that product market fit, the category that they want to go into. And, you know, I love this kind of concept of ikigai, and not just necessarily going into where you think the money is going to come. It needs to be something that you are genuinely interested and passionate about as well. However, I'd love to know from your experience, where should these individuals be looking right now? Like what is appealing from an acquirer's perspective?
We've mentioned obviously premium beauty and healthcare, but beyond that, is there any other?
Yeah, I would say, you know, start a male grooming business because look at our 3 cabinets over the last 10 years. They've, you know, evolved from Lynx hair gel all the way up to 50, 60 products. So that as a category is booming. It's not going away anytime soon. Men are slowly catching up with, you know, women in terms of what we're using. Which is great because we're getting better looking, and you know that's
the collagen injections next.
Exactly. Yeah, it's been well received. So yeah, that's great. But seriously, outside of that, you know, there's a lot of different ways to do it. I always say, you know, okay, let's go the influencer route. Find something that you're passionate about. There's always money to be made in something you're passionate about. Find an influencer that you can get connected with that also shares that. You know, influencers just, you know, they have such a network that can scale something so quickly at a lower, you know, customer acquisition cost if you don't have to spend 40% on marketing to scale something aggressively, you can have someone's network do it. That's great. Watch out though is obviously when it does come to acquisition time, the brand needs to be able to stand on its own, which I think IM8, as an example, is doing a great job, because you don't go on there and it's David Beckham.
It's not over-indexed on David Beckham.
It's not. It's all about the scientific board that backs it and stuff like that. So that's one. I think baby and pet are, recession proof. So no matter how bad things get, people will buy in baby, people buy in pet. And I think look at again, another school is look at where people are making headlines as their way to piggyback off the awareness, is there low competition. For anyone starting out, I would say fail fast, fail multiple times, don't fail expensive. Don't be afraid as well to reach out to M&A firms and speak and find out what's happening on trends. And because, I see all kinds of P&Ls cross my desk from, we're the next big thing and they've done 400K of revenue. And, you get a sense of what they're doing and how they're doing it, all the way to, we're doing 50, 60 million revenue.
I also think with AI now, it's like becoming extremely easy to be able to stress test product market fit before you actually invest into starting a brand or going all in. In its simplest form, wait lists, right? Like that's one way that you can, get a gauge for demand. Other than that, you can, I think there was an example you shared recently where you could model a product very easily through AI that doesn't necessarily exist and drive traffic to a site that, isn't necessarily buying the product through.
Just refund it.
Yeah, either buying the product and refunding it or going through to a wait list as an opportunity to potentially A/B test different products that tap into different problems.
Yeah, I'm bullish on smoke. That's like a smoke screen test. I think it's the reason I really like that is because it's very different getting someone to part with money versus getting them to part with an email address. So the further closer to get a signal on track product market fit for a couple of grand just through a meta and make some ads, render up a product, put it on a landing page, and then test and figure that out. But I agree, that is the value of. That is ecom, right? It's meant to be lean and quick. And
I think if you can, for anybody looking to start out, unfortunately, build a P&L, realistically, can you, I think if you can't make north of 70% gross margin, don't do it. Because it's going to be, there's too much fluctuation in the world. Yeah. The P&L will go north and south and you won't be able to keep up. And by the way, most ecom businesses fail because they can't keep up with their growth. So heavily reliant on inventory. You don't want to get into a situation where you've got to immediately go off and raise capital, and you haven't proven yourself enough. You're going to get killed on valuation. You're going to end up giving away 30% of the company just to stay in stock. That's never good. So, do your financials. Once the financial model is sound, you can sleep at night. Everything else can be tackled and solved. Anyone who's listening to this, who's an entrepreneur, entrepreneurship is your life is just one big problem that has to be solved. And you solve one, you get on to the next, and you have a passion for doing that. My advice to ecom sellers as well is sell when you're on the up. It's ecom is high growth, high energy. The landscape changes on a weekly, monthly basis. It's not like dusty old brick and mortar where things sit on shelves. It's exciting, but in my experience, you give an ecom business enough time to mess up, and it often will. So you want to sell on the up. You want to have enough headway made on your forecast to get people excited, to get the valuation you want. But don't get too greedy. We all think we're the next Steve Jobs, and few of us are.
Segues nicely into Beauty Value Lab, the new project that you're launching. That's all around helping brand owners get above their target valuation, or an outcome that they would be thrilled by when they go through this process. Can you give us a bit of background and give some info to the listeners a bit on what that is and how you're looking to help the category?
Yeah, that's right. So as we say, value isn't lost at the negotiating table, or most of the value isn't lost at the negotiating table. It's lost years before by not making the right moves. And, the reality we all live in is your ceiling of what you can achieve is the circle you surround yourself by. So, if I'm a beauty founder, I should want to be surrounding myself by successful beauty founders who've solved all the problems that are ahead of me. I should want to get involved. If I'm really thinking about an exit in the next 2 or 3 years, I should want to get involved in an M&A firm that offers a commercially friendly way to do that. I don't want to pay, hundreds of thousands in retainers over years of work because I'm a certain size, and that doesn't make sense. So Beauty Value Labs was created to bring high quality beauty founders together that are doing anywhere from north of 10 million revenue to 200 million in revenue, together to get a sense of where their valuation is today and where their valuation is for where they want to grow to stress test their forecast. And then what we do, so that's the direct kind of valuation work that we're doing actively with members. Then what we host is we'll host webinars with acquirers, and we'll, do something similar to this where we stress test acquisition criteria that they're looking for. It's like you go to sell your house, a real estate agent comes in and say, I can get you $1 million, and great. But it's not he or she who'll set the market. It's the person buying your house. Mm-hmm. And if you're left with one buyer and they only value it at 700K, then that's what your company is worth. Your company is worth what the market will pay for it. So double clicking in on what acquirers value, how they build value and model up value is really important to understand, because it'll either expand your timeline or shorten it. And then you get the opportunity to obviously build relationships with those acquirers, understand where the blind spots are in your forecast. And I love to think of Beauty Value Labs as like, we all have our growth strategy. It's all internal. It might be developed with your C-suite, it might be developed with some advisors, but it's about getting the Twitter blue tick, I'm old school now calling it Twitter, but the blue tick seal of approval on that internal growth strategy by stress testing it with what the market wants. Yeah. Because if you don't do that, ultimately, you're not going to get the best valuation. So it's about showing founders if their valuation expectations are real, what they truly are today. And we are in a great position to do so because it's what we obsess over every day. And we've got that unemotional, impartial view, the financial lens that an acquirer will take on the business. And then, you're meeting and networking with fellow entrepreneurs who can help you solve any problem that comes up or give you guidance, because often founders will find themselves sat in a dark room with an AI model, asking them all these questions, swearing at them through the keyboard, saying, you're wrong, it needs to be this, I've heard it's this. And AI will say, you're absolutely right. So it's trying to get the real honest answers from people who've been there, done that. So there's strength in a network, there's strength in growing together, and there's strength in tapping in and engaging with the market ahead of an exit process. The great thing about Beauty Value Labs is we get to speak with acquirers and we get to speak with beauty entrepreneurs, and we get to double click in on that niche. Beauty entrepreneurs get to network with peers and acquirers. They're not contractually obligated to use us as an M&A firm, although the more we learn about the business, there's strength in doing so, but they have freedom of movement there. And it's commercially sensitive to a long engagement. It's not really cost heavy. It's significantly less than hiring one advisor to come and help you on your business. So you're almost getting like a peer-tested board of advisors and tap in with the market. It's going to inevitably lead to higher valuations and more secure valuations. You talk about for founders achieving higher valuations. In today's market, it's about achieving an exit. Yeah. It's getting harder and harder to exit your business. So it's actually about achieving that exit, but then, building on what gets me a higher valuation.
Makes sense. And I think I like the form of like category specific. I feel like a lot of founders, a lot of founders maybe shy away from spending time with direct competitors, people operating very close to their space or close to their
territorial,
their customers. And I actually think that's where you'll find the most value.
100%. And
there's so much to go around.
You're not coming into this disclosing all of your data in your network. So you get full control over what you disclose. It's about, this person has solved this problem and it's a big one for me. I want really the step-by-step how they've done that. That's invaluable. And you're right. We introduce it because we see so many ecom networks where it's not category specific, but everybody's got category specific problems. The problems that a beauty entrepreneur will be facing on a daily basis very different to what you might be facing
fashion,
in fashion, or high returns in fashion. Well, inventory, I don't really have that, So getting access to who's actually going to solve problems and help you is great. And it's not just about, your competitors. In that community, there are people who've exited businesses who want to give back. There'll access to acquirers and stuff. So at our conference, we run an annual conference every year in New York that's exclusively focused on acquirers. It's the leading e-commerce acquire event globally. We've been running it for the last 4 years. It's a room in the beautiful Convene building in downtown New York that's full of private equity, strategic acquirers, ultra high net worth individuals and brand founders coming together to discuss what are the key trends in value drivers of ecom businesses and of valuations of ecom businesses. We'll do a hard launch of the Beauty Value Labs network there. So, we're really excited about that. We think the network's going to grow big. I would just say, for anybody that wants to listen and get involved in that, reach out to any one of us at the Fortia Group, and we'd be happy to have a conversation.
We'll put the link to the one pager and the direct landing page in the description, so they can go straight through, and we'll be tagging yourself there. So but I think if you're in that space, if you're in that category, it's a no-brainer to surround yourself with that kind of circle and get access to that kind of information.
Yeah, just everybody wants to scale quicker and without as many mistakes. So
it's like the classic, you're a product of the 5 closest people to you, and if those closest people are those that you're aspiring to become and that have been through what you've been through, then it will accelerate that growth.
It's funny you say that, because we recently ran a podcast with successful sellers, and the most common theme was, before AI, it was so lonely. It's so lonely to exit your business. You can't tell your team, can't tell your customers, obviously. You're having a lot of soul conversations, and these are big, high value, life-changing conversations. It's hard not to get excited about that and passionate about that. Sorry. But so when AI came along, one of the founders on the podcast said, I started speaking to AI, as sad and all as that is. I started sharing the news with, I'm going to do this. I had to tell somebody, because often, private entrepreneurs, they don't want to disclose the value that's coming, because they want it to remain secret. Everybody's going to know, their friends, their family are going to treat them a little different. So it's not really something you want to disclose. So they need to talk to someone about it. So who you surround yourself with is super important, because especially as you near the conversations, hey, I'm speaking with such and such an acquirer. I've spoken with them before. Have they spoken about this? Or, those kind of conversations are not something that typically founders would have directly with folk that are speaking to the same acquirer. So that's really interesting.
Yeah, makes a lot of sense. So you can kind of plot like you mentioned interest rates when we're looking at like the last few years of the market, and how that's kind of like trends with obviously capital availability, and therefore is often like a leading indicator of where the market is going.
There's an inverse correlation between interest rates and global M&A trends for sure. Yeah. Over the last 30 to 50 years.
Down equals up. Sorry.
Yeah.
I got the words wrong. And I think a lot of that is obviously, and I also think you can do the same with growth rate of brands somewhat, because they've got available capital to invest. And that creates like a more favorable environment for them to maybe take growth capital on, use that to fund next stage of growth.
Yeah.
We mentioned AI, and we in terms of like building in the business, but I see AI as potentially being another facilitator of this next era of e-commerce, where AI allows brands to strip off meaningful percentages of OpEx.
Yeah.
And use that and divert, like what is going to be the biggest winner of AI efficiency should be marketing spend, because you should just be able to take your P&L, rebalance the P&L.
Yeah.
And therefore we enter hopefully this next era of rapid, more accelerating growth and efficiency if it continues to play out like that. Just wondered what your thoughts were on that.
Yeah, and again, like it's two schools of thought. So you don't want to get caught out by making all these efficiencies on your side, and then the acquirer looks at it and goes, I'm not doing this. I can't match that, or you're doing something so niche.
Being like too lean, like you were saying.
Yeah, too lean. I've got to manage my risk here. So that's one. I think the more common thing though is, that's gonna happen. It's probably gonna happen. Not necessarily in-house. I don't think you're going to be building anything, but the agencies and growth partners that you're getting involved in, this will be crucial for them.
Already is for us, yeah.
Yeah, for sure. It'll be more commercially friendly, maybe, or just the results will be more friendly in terms of what you get out of that spend. So that'll be really important. So you'll be able to scale quicker, smarter. Again, have more data, versus building AI, kind of like building LLMs that are completely automating MPD development for us. And therefore there's zero cost or minimal cost associated with that. An acquirer is more than likely going to go, I then have to scrutinize what that is and what that looks like, and is that investable versus
do I even understand it?
Yeah, I'm just going to do this. So again, I see it as being like really important in terms of the hygiene of a P&L and efficiencies you can make. I don't see it being something that an acquirer is going to go, gosh, I love that asset. But it's going to become super common in the agencies and partners that you work with.
100%. Yeah. I wonder if we will see that $100 million ecom brand with one person running it that everyone keeps talking about is like the theoretical end state.
I've sooner than you think with SaaS.
I've certainly come across, I've come across 50 to 100 million DTC companies with, three FTEs running it, and just highly leveraged and with expert agencies and stuff like that. So I think that's what's super attractive about it as well, versus brick and mortar, where things get fragmented really quick and you have to start doing negotiations, and you've got category data and stuff like that. You can really just build from a lean team really quickly with ecom.
Yeah. Perfect. Well, final question. For a founder listening, wanting to exit in 2 to 3 years, what should they do this week, next week as a starting point, other than reach out to yourself?
Well, reach out to the Fortia Group. Reach out
right up there.
Reach out to an M&A firm.
Yeah.
You don't need to hire an M&A firm. You should. You don't need, but please speak to an M&A firm. It's like walking into an interrogation room without your lawyer. You just don't do that. You're dealing with experts. You're dealing with M&A machines. If you're really interested and serious about exiting over the next 12 to 18 months, speak to an advisor and see where the market is at. It's too much of a heavy lift, unless you've got all these AI models and you've all this free time and you're twiddling your thumbs going, God, ecom's easy. it's too much of a heavy lift to truly understand. And the Fortia Group, we spend a lot of money on systems and tech and access to data that's just not available to the average founder. So we're spending the capital, engage with an M&A firm that has access to this data.
Perfect.
Well, yeah, thank you so much for coming on. I think it's been super, super valuable. As I say, we'll put your information down below, so anyone listening, please get in touch with Paul. But yeah, thanks a lot for coming on.
Great. Thanks for having me, guys.
Man. Appreciate it.